India is a great long-term growth story, and the medium-term picture also may look good. The question is, in the period before the medium term, can there be some bit of a larger dip than what the normal buy-on dip proponents would advocate?
So I think, clearly those are subjective questions, but let me kind of frame my thinking just to put some guardrails around what we are talking about. At the end of the day, in the United States, there is a war going on between the Fed and the consumer. And basically, till the time the consumer relents, the Fed has said in the recent meeting that it will continue to hike its rates till the time the inflation is to a certain level. Now, that has its implications in the sense it has an implication on the interest rates, it has an implication on dollar index, and that has a bearing on emerging market flows and all the macro nice stuff that economic channels are full of. But underneath all of these is an incipient economic recovery which is happening in India, which is fairly robust. Certain aspects of that might get pushed out given if the dollar index is kind of stronger, or if the flows are longer, or the flows take a bit longer to come, but it doesn't change the nature of the economic recovery that is quite domestic focused come through. In fact, if anything, if on the back of global growth worries, which we will probably get to in the next 3 to 6 months, some of the commodity prices actually cool down, it might actually mean positive from the near term economic growth forecast, because all of us have generally penciled in a fairly high commodity forecast in our earnings estimates, so to speak. So in summary, as you said, the medium term is a combination of quite a few short terms, and in the short term, clearly the rates and the flows are a negative. But the silver lining on the cloud is that on the back of this, if commodity prices cool down, then that would mean a positive fillip to the economic recovery, and certain aspects of the economy that we like to bet on continues to stay that way, irrespective of this rate decision. So, a few leading comments, whichever way you want to take it.
Yeah, no, thanks, and these really help. Let me get in Harish's view out here as well. Harish, that's the key question, right? Let's assume that the economy and with maybe due reason that the economic recovery in India and the economic growth, compared to relative and in absolute terms, is not looking all that bad. Yes, a few telltale signs in the recent past and the last couple of days have been a bit worrying, but that notwithstanding, the question is, since, as Tridib said, that the medium term is full of a few short terms, is the immediate short term likely to be of some pain to the market value that is ascribed to equities by and large?
Right, Neeraj, I think it's a great framing of the question, with the caveat that, of course, in the near term, I think we're all blind men trying to guess which side the direction of the market is. So with that caveat out of the way, I think it's been about, 9-10 months since macro has scrapped all the conversation, right? Every aspect, every decision making, every chaiwala, panwala is talking about what's going to happen as far as interest rates is concerned, when the next meeting is happening, etc. And it's generally a sense that when macro becomes mainstream, I think it starts losing less and less potency as far as its ability to move markets. So that's point number one. The second point is, we all know that one doesn't make money by trading today's headlines. One possibly makes some amount of money if one gets both the direction and the magnitude of the headlines, which can potentially be 6-12 months down the line. And over there, our sense that we are getting is, there were two broad worries that triggered this macro correction. One is, where is the cost of capital going to settle at in the longer term basis? Again, I can't stress enough, equities is a long duration play, and therefore, while the near term movements of whether it's a pivot, no pivot, 75, 50, 25, etc., may move some asset classes, as far as equity markets are concerned, they are more worried about the longer term curve of where the global cost of capital is going to settle at. And the second, and possibly the more important point, I think that one needs to bear in mind is, where does the die kind of settle down or fall down? Where do the chips fall down? Because we are going through a very, very different period of time, wherein if you look at broadly, there are three engines of growth. You've got US, you've got the Eurozone, and you've got Asia, spearheaded by China. And each of them have got their own idiosyncrasies. While we speak a lot about Jackson Hole and the Fed moving markets, US is in a very good space compared to what Europe is going
Agreed.
through, and also where China is trying to move its overall economy. And India, I am completely in consonance with what Pradeep said. I think India is really standing out as one of the bright places to be in a global context. And therefore, yes, in the near term, yes, there is a repricing of risk. In some sense, maybe we moved on too soon from the lows as well, like in the last whatever 45 odd days. But it is important to keep the bigger picture in context. And with that bigger picture, I would think that to me, the worries of the global cost of capital running away are now behind us. I think we've reached some kind of a ceiling of sorts now, whether it is 350 for the 10-year or maybe slightly higher. I don't think we should be in a camp that worries significantly beyond that. And secondly, I think as far as the currency markets and where India stands, I think we are in a very, very good zone. So we need to keep both of these in mind, even as the near-term risk appetite kind of, loosens itself up in the real near term.